Right, it is now 11:02. So thank you very everybody for joining us this week. Our guest this week is Jean-Yves Delamez, who's the manager of Ecofin Global Utilities and Infrastructure. So he'll be talking to us in a little bit. First, I've got a few bits of news to have a look at. So there's very much a battery theme to what's been going on this week. There's been quite a lot of results actually from the renewable energy sector. So in addition to these two making some statements, they also had results from people like Greencoat UK Wind and from renewable energy infrastructure. But I just wanted to focus on the batteries, I think, because I think that's quite an interesting story. Harman Energy Income has done extremely well since launch in terms of NAV, as you can see there, climbing. It's not that old yet, so it only launched in November. It's moved out to trade at a discount when we had the mini budget ridiculousness last September. And although it recovered, it's drifted back out a little bit in the last few weeks. I don't think that's really deserved. And I know that it wants to grow. So I'm hoping that that's going to close again and we can actually get back to expanding the sector. Here it is in the context of everything else. As you can see here, there are a lot of funds now trading at a discount. And it seems to be sort of the majority of them. I'm not quite sure what's caused this next leg down, really. I think it might be that we've had this sort of slight panic that maybe inflation is not dead in the US and maybe rates won't come down as fast as people thought they would. But I don't really think that's as big an issue for this sector as has been sort of hinted at by what's going on with the discounts here. The discounts have already moved up a bit. And I don't think they may move up slightly more, but not a lot. So I think this sort of sell-off here is probably overdone. But we'll come back to that later, maybe. In terms of performance, we've only really got, as I say, 1 year from Harmony, and as I say, it is looking pretty decent. But we had some pretty strong returns last year, or last 12 months rather, from things like Greencoat there. And also Gresham House Energy Storage is the other battery fund. That's largely driven by inflation, but in terms of the battery storage funds, although Gore Street seems to have participated to some extent, it's also driven by their projects coming on stream. So they get valued on a lower discount rate once you've got past the kind of construction risk phase. And so that produces the uplift because Harmony Energy Income had its Pillswood project come on stream last year. So the first set of results it's announced, they're on to the end of October 2022, is obviously slightly historic now. But the 210 million that they raised at IPO is all deployed. They tried to raise some more in October. It got derailed by the mini budget, but they still managed to get 15 million. Those C shares that they issued have now been merged in with the ordinaries. The NAV, as we saw in the chart before, has climbed, and it's climbed again as at the 31st of January. So it's 125p. They've paid 2 1p dividends, and they're going to be starting to pay now 2p dividends quarterly going forward. So 8p a year. So 8% yield on the IPO price, which is obviously quite attractive. And they've arranged for 130 million of debt finance, not all of which has been deployed yet. So they've got some wiggle room there. Pillswood, as I said, has become operational. And at the time that happened, it was the largest in Europe by sort of megawatt hours. It's got 2-hour batteries. So the capacity of that is double the 96 megawatts that is shown there. And there's a big chunk of battery projects coming on stream before the end of 2023. So given that we've already seen that kind of NAV uplift, I think what we're saying is there's probably more NAV uplift baked into this. And we could see quite sort of strong performance there as we go forward through the year. There's also quite a big pipeline. So they arranged for a right first refusal from the managers developing these projects to be able to buy them from them. And there's 400 megawatts that are sort of ready to go, and they would like to pick up, but they will need more equity capital to do that. What they've got room, the debt facility is not big enough to do that. And this is what the portfolio looks like now. So Pillswood, as we said, they're Broaditch coming on stream next. It's a relatively small project though. Farnham project got delayed because the grid didn't want to switch off the power connection to the rest of the area, and that's at that sort of time when they were originally planning to do it. So pushed it back by a quarter. The others that are coming on stream, you can see there all the way through to 2023. Securing the grid connection is the major constraint to growing these funds. And so the fact that they've got so many things with a target operations date within a relatively short period of time is actually quite good news for them. And that speaks, I think, to the manager's sort of development expertise. Other things that have been playing to their advantage have been the volatile energy prices, because obviously they can take in power when prices are very low and then release it when prices are higher, and that is one way of generating income. There is a sort of shortage of capacity anyway, which because of these grid connection delays and various other bits and pieces, and that drives up revenues from the grid. One slightly odd thing that I hadn't appreciated until these results is that although they've got sort of a balancing mechanism revenue where they sort of stand ready to deliver power into the grid if something else falls off, the grid's actually been not calling on them, even though they've needed the power. They've actually gone to larger power stations instead. I didn't think that was something that they could do, but apparently this has changed in the last few months, and so that revenue is starting to come through, and that'll be a much more important part of the slice of the pie for 2023, they think. And then the capacity market contracts, which is the other sort of chunk of this, they've been coming in at quite high prices, as they talk through here. This is not a huge chunk of the revenue, but it is nice because there are two different sorts of it. So one of it is you either bid for providing capacity 4 years out, in which case you get revenue, and then that is index linked for 15 years. So there's a quite sort of nice predictable income if you can secure it. Or you go in the sort of top-up market, they call it T+1, the T1 auction, where it achieves higher prices, but that's much more unpredictable because you don't know until you get there how much excess of capacity there is in the system or shortage of capacity, and that's what's going to drive those auction clearance prices. So they struck in 2022 at the maximum of £75 a kilowatt hour. In 2023, and that price was lower, it's £60 a kilowatt hour, but still, it's still quite attractive, I think. Yeah, that's right. So there we go, and they've been lining up the capacity market revenue for the things that are coming on stream, and you can couple those with the energy trading stuff, so you can do capacity market and energy trading at the same time. So that's one way of adding additional revenue from these things. NextEnergy Solar is not alone. I mean, JDEN from a whole bunch of things have been adding batteries to their portfolios. They've sort of decided that they really want to go and push ahead with this. So they've asked investors to increase the limit on this from 10% of gross asset value to 25%. They've got two small operating batteries at the moment now, and they've got a 50 megawatt battery under construction, which is just 1 hour batteries in Scotland, which should come on stream in the next quarter. But they're working on a much bigger project. It's bigger than Pillswood, which is in Norfolk, which is due for delivery in 2025. And they're doing this in partnership with a firm called Eel Power, and they're targeting a development of a gigawatt in total. They're going to use, because I said the main constraint is the grid connections, they've decided it makes sense to co-locate batteries at their existing storage sites, which have got grid connections already. And so that is the route they're going down. Initially, they're going to use the spare debt capacity that they've got on the fund, which is about 108 million, they reckon, to do that. But as Tim's asked there, I think they will have to raise more capital for the energy storage strategy, and it's all going to depend around how much, where the discount's trading at. Hopefully be trading at a premium, they'll be able to do it, because as we said, these could be quite lucrative. This just illustrates what they think is the sort of potential revenue makeup for a 2 hour standalone battery project. So you can see that the trading stuff, which is the bright orange there, and the intraday stuff makes up the bulk of that. Balancing mechanism revenues still going to be quite important, but the capacity market stuff, even though it's nice because it's inflation linked and predictable, is actually quite a tiny part of the total. That's the dark blue at the top there. I also just wanted to mention before we finish up on this, because the chairman of Harmony Energy Income sort of picked up on it. There are a couple of different things that were trying to be achieved with the diversity on boards. One of them is to increase female participation, and that target was originally 1/3 of boards being female, and that's now 40%. And we are a long way towards achieving that within the sector and just across the UK stock market generally. One thing that they've decided to do is that a senior role should be held by a woman. And I think that's problematic, as we'll come on to. And then there's another thing called the Parker Review, where they're trying to increase the number of people from ethnic minorities on boards as well. So they target is to sort of 1 for every FTSE 100 company by the end of 2021, which wasn't quite met, but not far off. And I think that's now achieved. And then the same for the FTSE 250 by 2024. And I would imagine that will roll down, because that's what they did with the female targets fairly soon after that. I don't think these are too much of a problem generally. Where I think there probably is a problem is this definition of what constitutes a senior role. So for most companies, obviously they've got CEOs, CFOs, chairman, senior independent directors. Those 4 things are the things that sort of tend to qualify. The one thing they don't recognise as a senior role is the chair of the audit committee, which in an investment company is I think the other senior role apart from the chairman. The senior independent director is a nice thing to have. It's supposed to be the person that investors go and talk to if they've got a problem with the board or a problem with the chairman. And it's sort of like, the independent person that they can go and talk to. But it's not, I think, really that necessary in an investment company, because all of the members of the board are independent. And so there doesn't really need to be a SID, as they're called. So that just leaves the chair. And obviously you can't have a situation where you insist that every chair of every investment company is a woman. So they've got to, I think, change the definition of what constitutes senior. In the meantime, though, the proxy advisors, the things like ISS, are going to be saying you should be voting against these boards because they don't meet this target. And the chairman of Harmony Energy Income has quite rightly, I think, railed at the stupidity of this. And also, he makes, I think, the valid point, which is he's saying that it's daft that active managers are using proxy advisors to advise them how to vote at all. I mean, it's it is just sort of lazy fund management. If you are an active investor, you should be able to evaluate whether you want to vote yes or no on any kind of proposal for yourself without relying on an outside expert. They might be a useful thing for passive investment funds, but for active managers, the decisions to be made in-house. And the other things he says is, that if there are any problems, if any shareholder does have a problem with the board, their door is always open, and people should be engaging more with boards. And that's something that we've always said. Now we've got past COVID, I think, it would be nice to see more people going to AGMs, more people submitting projects to AGMs. I know there's a problem with some of their platforms that they don't make it quite hard for you to engage. And I had a problem personally the other day when I tried to appoint proxy to the home REIT board, and then they wouldn't actually let this person in because the letter didn't arrive. These things are problematic, but it shouldn't be impossible to get this done. And I think the more retail investors and active fund managers actually push for this stuff to happen, the more likely it is to get across the line. So that's enough from me. There's just a little graphic there that just shows how the number of women directors on boards has been growing. And you can see up to 9.1%. That's in 2021. Just to sort of illustrate that point. I will wrap up there.